was wrong with Smile? I mean, we've talked about the big high-profile IPOs that have had problems, the ride-sharing, WeWork. Smile Direct felt like it could have been another one of these. You're like, hey, it's Levi's again.
I mean, Leslie, it's weird because for me, that's a consumer story because that's targeting the strong consumer in America.
Exactly.
I'm going to hear what Leslie says first, but I did a little work on this as well. But what do you say on Smile Direct?
I will say it was very surprising, as Kelly mentions, because they did price above the range. So it's really rare to see a company price above the range and then trade down, especially to the extent
misread the demand.
They did.
Is that the banker's fault?
They misread the demand, exactly. And the bankers, along with the company who make the decisions on pricing. But, you know, in hindsight and talking to investors, this really was a valuation issue for them. I think a lot of people took issue with the fact that they were coming out at about 21 times last year's revenue. Align, which is a very easy peer that's currently traded.
And arguably the better known one.
And the better known one, slower growing, of course. So you do give some kind of a premium. You tend to give some kind of a premium to a faster growing company. But Align is only at 7 times.
Yeah.
Right.
So that's 3 times higher. And the market was basically just saying, that's not the kind of premium we want to give to them.
And I did a side-by-side comparison of Align with Smile Direct. If you want to invest in this category, who's the better candidate? One is profitable. Smile Direct is not. The debt-to-equity ratio, 102% for Smile Direct. For Align Technology, they have virtually no debt.
Wow.
It's 0.04%. So, and, you know, the cash flow is much better. So all these things. However, they're not the best company overall either. The stock is down 53% in the last year. So I'm not sure this category
Exactly. And I wonder if it's
that popular.
Remember how much
right
we
now?
talked about the meal kit category and whether
is
you
this
know
a repeat of
the
that,
competitive
you know?
dynamics
And
here
let's
are
not
just
even
as tight.
talk about what this means for WeWork by the time this is all done.
Well,
we're going to talk ad nauseum about
Yeah.
WeWork, no worries. Let's talk some Apple, though. A bearish call from Goldman today, in fact, making them the biggest bear on the stock on the street. Goldman dropping its price target on Apple from $187 all the way to $165, and the shares are at $217 today. The analyst says Apple's accounting method for its year-long Apple TV Plus trial offer will have a material negative impact on earnings. Shares down 2.5%.
essentially, the way they will do it, and it's not illegal, but if you buy an Apple iPhone 11, you get 1 year of Apple TV Plus.
Valued at $60.
Valued at $60. The revenue, though, doesn't go for what you paid for the iPhone because you're not paying anything for the Apple TV Plus. However, the revenue recognition will go to the services side. So you see what Apple's trying to do, trying to beef up their services revenue at a time when they want to emphasize. Exactly.
But it is proportional, though. I mean, what they've done is essence take that $60 and then allocate that $60 between how much goes to services. It's like $4 and change. The rest of it goes as a discount to the phone itself. So it squeezes the profit margin.
Goes the
margins go,
Yep.
and all of that stays intact. So basically, this is applying a multiple on a lower earnings per share base, and then that gets you.
And Goldman may do it that way, but the question are the shares actually going to trade that way, or are they going to trade on this idea that nope, this is a step that's going to put the stock in a better footing for the long run and kind of give them the benefit of the doubt?
I think that's the key question. How do the rest of the analysts on Wall Street look at these accounting issues, as Goldman would point out? Do they take issue with the bundle, or do they say, you know what, listen, this is just kind of a specific
One-off,
thing for the iPhone 11 Pro. We'll give them this, time to beef up that side of the business, and then, we'll take a closer look.
They even say, by the way, this is a 1-year thing.
Right.
And if it goes beyond a year, then they really have to revalue the way that this thing is going to work.
Well, and if they're right, that's a lot of downside. And that's why it's catching plenty of attention today. Another one flying the coop. Next story is that sources tell CNBC billionaire investor Carl Icahn is moving his hedge fund from New York to Florida early next year. He becomes the latest in a long line of billionaires, including David Tepper, Paul Tudor Jones, and Barry Sternlicht, all who have fled high-tax states like New York, New Jersey, and Connecticut for income tax-free Florida. And it's not just the power players that catch my attention. It's the mom and pops who are doing this every day, you guys. I hate hearing these stories. I hate it.
I was just up in Connecticut a couple weeks ago, and the amount of for sale sign. I mean, Dom would see this every day.
Dom's like,
sitting
thanks a
next
lot.
to a Connecticut resident. But you go around these neighborhoods, and every other house has a for sale sign in front of it. Connecticut, of course, is a big home for
I would
hedge
say
funds.
this. What's interesting about what Leslie's observation was there are certain jurisdictions, town-wise, in Connecticut that do not allow you to put up a for sale sign.
Oh my goodness.
Including the town that I live in. So you have to go through yes, you have to
wasn't
look it up.
visiting
Or you have to, but it's a way for them to kind of say to them, so we don't see for sale signs everywhere.
Sure.
Because you're not allowed to have them up. So
Right.
it's probably understating even how
Which
many more
is
houses
shocking.
are for sale.
And
Yeah.
you have to applaud Florida and Rick Scott and everybody else who set this state up to do what it's doing now. You can't just take it for granted. Oh, yeah, people leaving New York for. No, this was a dedicated tactical move. It's taken a decade to play out, and it goes. It's catching momentum, Bill.
secular.
And when people, they put up the sign that says "Congratulations, so and so" on their high school graduation, and next to it is the for sale sign. And when you ask where they're going south.
They're going to Disney World. That's
Why
what it's
is it
all
always
about.
Florida, though? They never move to Texas.
South Carolina,
They never move
Carolinas,
to
yeah, I mean, it's
Carolinas
like-
are big.
It's always Florida.
I don't know. Well, it's about taxes.
You know what?
It's
They
the
go to
free
Florida.
market. It's
They-
the smart money-making
Yes.
move to try and preserve capital.
But
that's what it's all about.
For the investment business, too, you have to have that sort of nucleus. Enough of the services, enough of the business. They have that now. It's competitive. We are all on notice. Okay, next up.
Absolutely.
The House Judiciary Committee is asking Facebook, Amazon, Apple, and Alphabet to turn over documents as part of an antitrust probe. Part of the inquiry focuses on emails about their acquisitions. They want to know how the companies described these competitive threats. My main question on this is a request for emails very different from a demand for emails, and how much is going to turn up?
I don't know, Bill.
They're
This is
asking
tough.
all the right questions, I think, of each of the companies. They're asking different questions of each company as it pertains to competition. My question then becomes, how far are they willing to go with this investigation? Are they willing to break up Facebook because they bought competitors to squelch competition? Are they willing to force Google to change the algorithm on its search engine to make it more fair? Same thing for Amazon against the competition. Will they make Apple change their app so that it's fairer and less expensive for those app developers who want to put an app on their app store? I mean, that's what you would think they're heading toward. Are they just heading towards a photo op with a settlement of some kind and call it a day?
And I'll
I
just
hope
mention,
not.
because those are the biggest issues. So on the same page would be, once you start getting emails out there, you start wondering about individual executives. Listen, I'm sure they're a little nervous right now. Emails in general always turn up some turn of phrase or way of describing that just casts everything in the worst possible light. And as an investor, I'd probably be a little bit worried, too, about the risk, which is why I wonder, are they just going to turn over what they want to turn over? Or are they going to have to turn over a lot more?
Well, I think, too, the laws on the books as it relates to antitrust don't really cover this area. Historically,
it's gray.
It's all about, it's gray.
Yeah.
And historically, if you go back hundreds of years, it's really all been about just prices for consumers, back to the trust busting days. Is this raising prices for consumers based on monopolistic activities?
Right.
So Facebook, Google, they're not raising prices for consumers.
No,
The
there is no
laws
price.
need to be rewritten to account for any
Which is
kind
something
of
that-
anti-competitive
Which
behavior
is something
in
they
this
are
new
looking
world.
at as well, whether
It
that
is.
needs to be done.
And the question is, do the emails, would they break current law, or would they break future law that has
Future
yet to
law.
be written that would justify breaking the law?
Here's a way to look at it, though. There used to be a time when that was considered foresight, business-wise, to be able to look at where your competitors are down the line and see how you could fight them off, put the moat around you, do all that kind of stuff. And so if it was treated that way in emails, then maybe it doesn't look so bad. But all it takes is some colorful language, and then all of a sudden it goes out the
I
window.
totally agree. All right, finally today, Dinwiddie bonds. They're not bonds with a negative yield, or at least they're not supposed to be. These are bonds being offered by Brooklyn Nets guard Spencer Dinwiddie, who reportedly plans to offer them based on his 3-year, $34 million NBA contract. The bonds will be offered in the form of a digital token, by the way. They give buyers a cut of his contract with the Nets plus interest in return for him getting the smaller lump sum payment up front that he can immediately invest.
All right, so this immediately, when I saw the story, reminds me of the Fantex days, right? I mean,
Yes.
exactly.
Yes.
And the only reason why I was such a big kind of reader of the story was because one of the first guys that came out with that Fantex securitization deal was then San Francisco tight end Vernon Davis, who sacrificed, who got $4 million up front and sold away a 10% slice of his future rights, endorsements, earnings, and everything else. To me, it never seemed to gain any kind of ground.
It didn't, it hasn't worked a lot. The interesting difference about this one is Dinwiddie is not saying, I'm going to give you a piece of my future earnings no matter what they are. He's basically just saying, it's like if any of us offered up our salary and said, I have a contract, let's say I want the money up front and I'm going to and then I'll return it to you with interest. My question is, what's the coupon on this? How is he sure? Is the money guaranteed to investors? And if so, all the risk is on Dinwiddie. He now has to invest this money in a 3-year time span, make enough to return it and cover that payment to make it worthwhile.